So I've told you guys what I look for whenever I'm looking for the right stock. I've told you guys why I look for those things when I'm looking for the right stock. I've even told you guys what I've invested in. But I haven't told you guys how I actually go about looking for the right stock amongst thousands of companies. Have I? Need I say any more? Keep watching. Hi guys, it's your favourite YouTuber again, Dami Solari, and you're watching DS Learning Finance. Whoa, whoa, whoa. Yes, there is a way to sift through all those nonsensical companies to find that one true stock. And the method I like to use is called the ultra pure electrically filtrating stock system. Yeah, straightforward, isn't it? Yeah. Some people, well, the weird ones, call it stock filters or stock screener. I like to call it the ultra porous electrically filtrating stock system. Yeah. What? Stock filters do exactly what they say on the tin. It allows you to sieve between the good stocks and the bad nonsensical stocks that you just don't want anything to do with. Yeah. Now I like to use the LSE, the London Stock Exchange stock filter. But that's my preference. All you just have to do is type into Google stock filter and there are tons. On to the nitty-gritty. There are tons of parameters in those stock filters slash screeners that you can use. But it's totally dependent on what type of trader you are. Me as a long-term slash medium-term investor, I look for the following things. The first one is called the PE ratio, and I've talked so many times about this. The PE ratio is the price to earnings ratio, and what it allows you to be able to determine from the number it gives is how a stock is valued. So a high PE ratio means a stock is overvalued, and a low PE ratio means that the stock is undervalued. But the way that I set my stock filter is to make sure that the stocks that I'm looking at aren't above a certain figure. So my figure tends to be 25. So if the price is 25, is more than 25 times the earning per share, then majority of the time I'm not really interested in the stock. There are some exceptions, but majority of the time I'm not interested. You have to remember, in order to be a successful investor, you really have to maximize your profits, and the way that you do that is by literally buying stocks when they are undervalued and selling them at their maximum price, i.e. when they're overvalued. So getting a good grasp of the PE ratio is a very positive thing to do whenever you're looking for the right stock to invest in. Two, I don't know why I did that, is the stock market price. Now this one goes without saying. How much are you willing to spend on your stocks? Guess what? Even if the financials are saying that this company is like solid, even if you've read all the business plans, all the 10Qs, 10Ks and whatever, you've read all of that and you think that the business is great, guess what? If the share price is too high, then it means that the stock is overvalued. So you could have done all that work to find out that it's actually overvalued stock, even though it is a good company. So making sure that the share price is a reasonable value is definitely important. I personally don't like to spend more than £10, but this isn't a set in stone rule. It's just a sort of guideline I like to use. So £10 per share, I would say, is the maximum I'll go up to. Maybe I might go up in the future when I get richer. As for now, your boy's not gonna spend more than £10 per share. 3 is the stock market index. What index are you looking to enter? So this can be anything from the FTSE 100 to the FTSE 250 to the Dow Jones to the NASDAQ to the S&P 500. Whatever you're thinking of investing in, you need to know what market in terms of index it's involved in. And with that said, tailor that to what type of investor you are. So for example, if you're a fresh new investor that's like looking for long-term success, are you looking for safety and stability, you might want to invest in stocks that are significantly established and stable. So you might want to invest in the larger indexes like the FTSE 100, the top indexes, the Dow Jones and so on. But if maybe you're a more seasoned investor who is looking to take a considerable amount of risk but for high gains, then, and obviously you've got more experience, then you might be more inclined to invest in maybe the more risky, the more volatile stocks, so the stocks that may be in the AIMS market, for example, and so on. So you've got to tailor what sort of stock you're looking for to what sort of investor you want to be and are at that current time. 4 is highly related to point 3, and by that it is what is the market capitalization that you're looking for that stock to have. The market cap basically shows you how dominant a stock is in regards to the rest of the market, and the way it does that is by calculating the current share price of that stock times by the number of investors and how many shares those investors own. So basically it tells you how much money in total all the investors have in regards to that one particular stock. So it's a very important number to know, but the way that I use it, I actually think is pretty clever. And that's because of one term called a breakout. I typically look for stocks that have their market cap increasing to such a stage where they're literally knocking on the door of joining that next group up with larger market caps, i.e. a larger market index. What that effectively means is 2 things. A, your company's doing really well. Why? Because the market cap is increasing. They're getting more and more investors to buy more and more shares, which is always a good thing because you've done the research, you know this company is a good company, and guess what? It's being a good company. B, the share price increases. Money. I know, I like money. Yeah, so the share price increases, generically speaking, after straight as a breakout occurs, and that's generally because the public tend to overvalue that stock. That's why I typically look for a breakout, because generically speaking, the share price goes up dramatically. It may not stay up for a long time, but it still goes up large enough for you to make a good amount of profit from, if you play it smart. For example, the stocks in the FTSE 100 tend to have a market cap greater than 4.8 billion, and then the FTSE 250s from 4.8 billion down to 0.8 billion. What I would particularly look for is stocks that are in that 4.8 range. Yeah, that are still in the 250, FTSE 250, because if they keep on doing as well as they show what they're doing, then they're very well likely to enter the FTSE 100, which means breakout, which you know means more money. But that's just one example of one thing that I could do. Wow, I can't believe I'm giving away all my secrets, but hey, it's you guys, so it's definitely worth it. Now I've had to split this video into 2 parts, simply because it will take too long to fit all of this into one video, okay? So watch out for next week's video, which will be part 2, because it will be a continuation from this week's video. And make sure you definitely watch those ones, because those 2 to 3 bonus filters that I include whenever I'm trying to have a screening process for stocks to find the right stock, I would say those 2 to 3 are probably more important than the ones I've even discussed today. So definitely make sure you watch it. It's your favorite YouTuber, Dami Solari. I talk about stock market investments, I talk about property investments, financial managements too. And don't forget to like, subscribe and share. DS Learning Finance. Whoa. Bye guys.